real estate's just a different thing. It exists to serve tenants. It's where your economy happens. It's a good thing to have in your portfolio. Like I said, most people are under allocated to it today. I think most of them should be sort of leaning into that sector and taking maybe a few chips off the table in other places, if you will.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. Today, I'm joined by Mike Acton, Head of Research and Strategy for North America at Global Real Estate Asset Manager, AEW. Mike is with me to share his latest thinking on the direction of the CRE market as we round out 2025 and look to 2026. Mike, thanks for joining the podcast.
Oh, great. Thanks for having me, Sarah.
So, Mike, in a recent report, you noted that commercial real estate is in a new valuation upcycle as opposed to a recession-led reset. What's behind your thinking there? And is this possibly different from past cycles that you've seen?
Every cycle's a little bit different. There's common features from one to the other. I've been at AEW 35 years, so I've been through a lot of cycles here. The current cycle is really interesting. We just had about 2.5 years of values going down quarter after quarter. In total, values went down about 20% on average, but yet there was no recession. That's the first time commercial property values in the U.S. have ever gone down on a sustained basis without there being an accompanying economic recession. So as somebody who does this professionally, I find that really interesting. You kind of have to lean into it. If there hasn't been cyclical downturn in occupancy and in rent, something else has to have happened. What happened here during that time period is the Federal Reserve moved interest rates a lot. And the yield that the investors demanded for property had to go up. So over that 2.5-year period where values went down, the earnings of the properties actually grew. Net operating income was up a little bit more than 10% over the same period. So you had earnings increase, yet value decline. What happened is the average yield on a property moved by about 100 basis points higher. So yields up, values down, as they say. So that's important to understand. When you think about a go forward, you can't be underwriting cyclical uplift in occupancy and rent if you haven't had cyclical downturn. So you're going to have to figure out how to generate your return some other way than just leaning into a recovery from a recession. There's a lot of places to look for growth out there, but it's much more typical of a late cycle earnings growth environment rather than a cyclical recovery.
And can you talk a little bit about the supply challenges in commercial real estate today and really which sectors are most impacted?
Well, we've just gone through a period of very high supply in things that had been very well performing a few years earlier. This is what happens in real estate. Values go up in a sector. It draws new capital in. All of a sudden, values are above replacement cost. Developers start building. And we had that happen a lot in 2021, 2022. I would argue even beyond that in industrial property and in multifamily property are probably the best examples. But now you fast forward a couple of years, values, as I said, are down. In most cases, I think values are meaningfully below replacement cost. So if you're in an environment where values are below replacement cost, it's really hard to underwrite building new properties. If it's going to cost you more to build it and you can sell it for, why build it? So what we've seen in the last 18 months or so is the supply wave in those sectors has completely rolled over. It's down a lot in industrial. It's just starting to fall and will fall fairly quickly from here, I think, in multifamily and apartment construction. There's really no office construction going on for reasons I'm sure your listeners can understand. There hasn't been much construction going on in retail for more than 10 years. So as a country, we're moving into an environment where we're just not going to build all that much. That's going to do a really interesting thing to this cycle. As I said before, the cycle really is caused by yields rising, not income falling in property. As we look forward, I think this next cycle has a chance to be a longer cycle because we're not going to be getting the same supply response, at least not in the next couple of years.
And obviously, we've had a couple of interest rates already in the last few months. Do current conditions make this a good entry point for commercial real estate investors? And how would you advise potential investors to approach the market right now?
I think there's a lot of indicators that show this is perhaps the best entry point, maybe in 10 years or so, maybe even going all the way back to right after the financial crisis. The yields in property are the highest they've been in at least 10 years. That's usually a good entry point. As I mentioned, values are below replacement cost. Everything else being equal, you'd rather buy in when their values are below replacement cost rather than above them. And when investors go to underwrite a property today, you can get to reasonable go-forward expected returns without having to make any really heroic assumptions about rent growth or occupancy improvement or any of those things in past periods people might have referred to as perfection underwriting. You're not having to do that today. So it feels pretty comfortable as a place to get in. As for what investors should be doing, it all starts with what you want the asset to do for your portfolio. People invest in real estate for a lot of reasons. It can give you good, strong income. It can give you diversification with things in the publicly traded markets. It can give you some inflation hedging. Today, I think the place to lean in is on income. I don't think we're going to have a lot of yield compression in property. Sure, the Fed's cutting rates, but I think the yield curve is going to steepen. I think property yields need to grow a little bit relative to treasury yields. So we're not counting on a lot of compression in yield driving value. I think for the next several years, I think most of the return in property is going to come from income. That's a good thing to have in your portfolio. It's a little bit out of favor today. Everybody wants to be in the Mag 7 and chasing the AI dot and all that. In some ways, that feels very similar to earlier periods. But income is really important to a lot of investors, and real estate's a place to get it.
And Mike, can I ask you specifically about REITs, how they fit into that big picture?
REITs are a way to get exposure to real estate. In some cases, it's the most efficient way for an investor to get exposure. There's a lot of investors out there who don't have the ability or the luxury to have a big private equity real estate portfolio. There's a lot of liquidity in the REIT market that's harder to come by in the private side. You can get exposure to sectors more easily than you might be able to accumulate on the private side. Some of these new emerging, smaller niche property sectors, as an example. So REITs, I think, are an important part of any investor's portfolio allocation to real estate. It's just a really efficient way to get exposure to the asset class.
And are the property classes in the REIT sector performing as you're seeing in the market more broadly?
Most of the sectors in the REIT market today are trading at prices that are quite a bit below anyone's estimate of what the assets themselves are worth. So again, when you go to your question of entry point, everything else being equal, you'd rather buy in when you're well below asset value, net asset value, than above. It creates a lot of interesting conditions. You're starting to see more M&A activity, not compared to several years ago, of course, but it's picking up from almost nothing to more. It's happening across more sectors. With the Fed starting the next easing cycle again, most likely that accelerates as we go into 2026. If companies are trading below what their assets are worth, somebody should be moving in there and arbitraging away that pricing anomaly.
Yeah, that was one of my follow-up questions about REIT M&A. We've seen it obviously in a few sectors lately. Do you see it in more sectors going forward or perhaps concentrated?
It's all speculative at this point, but I would say yes, because some of the discounts to net asset value are really large across different sectors. Things like life science, perhaps, or cold storage. These are sectors where, for whatever reason, investors are pricing that quite a bit below what the assets would sell for. So it just stands to reason that capital would come in and take advantage of that, either take the company private, merge it with something else. So I would think if interest rates, the Fed keeps lowering rates as we move into the new year, I would think you'd see quite a bit of pickup in that type of activity.
And Mike, what do you see as the biggest risk or blind spot in commercial real estate investing that institutional investors may not be fully pricing in right now?
The past two cycles, the recovery cycles in real estate, were driven, some of it was from real cyclical recovery in operating income. You had occupancy rates going up, you had rents going up. That was part of the story. But an awful lot of the value creation was driven by interest rates going down, in most cases going down a lot. That period after the financial crisis, the Fed and the other central banks took all interest rates, short and long. They forced all interest rates very low. Property, like other asset classes, responded very well to that. So you were able to amplify earnings growth into even much larger value increases. So if we just stay with that period right after the financial crisis, the next 5 years, net operating income across commercial property broadly went up about 20%, but values went up about 40% because the yield that investors demanded came down and amplified the value that was created by income growth. So I think investors tend to be always fighting the last war, if you will. They experience that. They assume that's what this is going to look like. I don't think that's what this next period is going to look like at all. I don't think we're going to have yields falling broadly. As I said, I think the Fed's going to cut short rates. I think the curve's going to re-steepen. And I think property needs to grow into a more normal spread to treasury yields. So I think it's going to be about finding places where you can really underwrite income growth, net operating income growth. I said that we had value decline without a recession, but there are some property sectors that went through something that looks and feels a lot like a classic recession. The one that really jumps to mind and most obvious is the senior housing space, the assisted living, memory care, independent living. That sector went through an event during and right after COVID that looks like a classic economic contraction. And right now we're having very robust recovery fundamentals of that sector, cyclical recovery, very different than what's going on in most of the other major property sectors. And of course, not to belabor the point, but we're right on the cusp of the very oldest baby boomers moving into their 80s. The first baby boomers, the people born in 1946, they're 79 years old this year. People don't really start moving into assisted living until they're in their early 80s. So over the next 5 years or so, we're going to have millions and millions of people moving into the age groups where they're going to be looking for housing alternatives. Some of that's going to show up in assisted living. Some of it's going to show up in things we probably haven't really envisioned yet.
So healthcare is obviously one big area for opportunity. As you look to 2026, any other potential areas to explore for opportunity?
I think you always have to be looking at the things that have been driven down the most. That's the natural place to start looking for places where you could have outsized uplift. Today, that would be places like most parts of the office sector. Life science has been particularly hurt. These are things where you have to have conviction. It's not for the faint of heart, if you will, but there are places where you're going to really have to dig in and get yourself comfortable that this particular situation that you've identified, one, you can underwrite it, and two, the upside potential is there to justify what's going to feel very uncomfortable. I think most investors today who are adding real estate to their portfolio really should be thinking about it more from adding income, durable, predictable income to their portfolio. But there are other investors that are willing to take a little bit of discomfort to pursue higher returns. And I think leaning into those sectors where things have gone wrong for the last few years is the natural place to start.
Mike, we've covered lots of ground, but any closing thoughts as we finish this year and look ahead?
Well, I mean, obviously we're in interesting times. There's a lot of uncertainty out there. There's a lot of disruption. Most investors that we interact with, and in my job that I interact with, are underallocated to real estate today. Everything's gone up in the stock market. It's all driven by AI, data centers, chips. It's essentially all the same trade. The whole world today, I would argue, is really leveraged to what you could call the AI trade across all asset classes, across wide swaths of the economy. Property it's a place of stability against all of that. There's a lot going on today that reminds me of the tech period back in the late 90s, early 2000s. Very different things going on. The companies then didn't have as visible earnings, and a lot of it was vaporware and things like that. It's much more real today. The economy's fundamentally changing. These sectors are really growing, but the valuations are extreme, and there's a lot of risk there. Real estate is your sort of anchor against all of that. People weren't interested in the good, solid, durable income story for real estate in 1988, 1999, 2000. They just weren't interested in it. The ones who actually leaned into it and added it to their portfolio were incredibly well served when the inevitable correction in all of the hot sectors, when that finally happened, the people who had taken the time to put some real estate in their portfolio were incredibly well served by it. And I think that same lesson is very much present today. Real estate's just a different thing. It exists to serve tenants. It's where your economy happens. It's a good thing to have in your portfolio. Like I said, most people are underallocated to it today. I think most of them should be sort of leaning into that sector and taking maybe a few chips off the table in other places, if you will.
Right. Is it possible to say any sort of percentage or any range that you think?
We work with what I would consider the largest, most sophisticated institutional investors in the world. And they typically have real estate allocations that are anywhere from, say, 10 to 15% of their portfolio. Within that real estate allocation, they might have 10, 15, 20% of that might be in the listed space. Increasingly, a lot of them are adding real estate private credit within that allocation. So there's a lot of evidence that the leading investors are doing something very different than what a lot of smaller investors, certainly what a lot of retail investors are not doing and probably should be. Those investors I'm talking about have very, very long track records of success.
Well, Mike, thank you so much for sharing your thoughts today.
Sure. Happy to do it. Thank you for having me.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.